There's a system, invisible to most, accepted by nearly all, that keeps the majority of people trapped in a cycle they don't even recognize they're in. It's not a conspiracy. It's something far more insidious. It's a machine that runs on your compliance, feeds on your habits, and profits from your belief that this is just how life works. And the most dangerous part, you defend it. You protect it. You teach it to your children without ever realizing what you're passing on. Let me start with some numbers that should make you uncomfortable. Total consumer debt in the United States now stands at $585 trillion as of the third quarter of 2025. That's a record high. The average American household carries $105,056 in debt, $105,000. But here's the part that should really disturb you. Americans saved an average of just 6% of their disposable income in 2024, and in 2025, that average is even lower, 4%. Think about that ratio for a moment. Record debt, historic lows in saving, that's not coincidence. That's design. And before you think this is just about irresponsible people making bad decisions, before you distance yourself from this reality because you think it doesn't apply to you, let me tell you something that might shatter that comfortable delusion. 42% of Americans have no personal savings at all. None. Zero. And of those who do save, the average is just 25,000. This isn't happening by accident. This is the result of a system that has been perfected over generations. A system that has learned exactly how to keep you working, spending, borrowing, and never quite getting ahead. And the brilliance of it, the absolute genius of it, is that you think you're making free choices. Let me take you back to a conversation I had years ago. I was meeting with a young couple, mid-30s, both working, good jobs, decent income, and they were drowning. Not because they were reckless, not because they were stupid, but because they had done everything they were supposed to do. They'd gone to college, taken out student loans because that's what you do, right? You invest in your education. They'd bought a house because that's the American dream, taken out a 30-year mortgage. They'd bought new cars because you need reliable transportation. Financed those too, of course. And they had credit cards for emergencies and convenience. And when I looked at their financial picture, when I really examined it, I realized they were working almost exclusively to service debt. Their income went to mortgage payments, car payments, student loan payments, credit card minimums. What was left barely covered their living expenses. They weren't building wealth. They were treading water. And they were exhausted. How did this happen? The wife asked me, and there was genuine confusion in her voice. We did everything right. And that's when it hit me. That's when I really understood. They had done everything right, according to the system. They had followed every rule, believed every promise, made every smart decision they were told to make. And the system had worked perfectly, not for them, but on them. Because here's what nobody tells you. Here's the truth that would break the entire machine if everyone understood it. The system isn't designed to make you wealthy. It's designed to keep you productive, to keep you consuming, to keep you dependent, to keep you just comfortable enough that you don't revolt, but just stressed enough that you keep working harder. Think about how you were raised to think about money. Go to school. Get good grades, go to college, get a good job, buy a house, get married, have kids, buy things to fill your house, finance it all, work for 40 years, retire at 65 if you're lucky, hope you saved enough, hope you live long enough to enjoy it, hope the market doesn't crash right when you need it, hope. That's not a financial plan, that's a prayer, and yet that's what passes for financial wisdom in our society. Now let me show you how deep this goes. In early 2024, 28% of U.S. consumers said that their main source of personal non-mortgage debt were their credit card bills. Credit cards. The most expensive form of consumer debt. The average credit card rate reached a historic high of 21.76%. 21.76%. Do you understand what that means? If you carry a balance of just $5,000 on your credit card at that rate, you're paying over $1,000 a year just in interest. Not reducing your principal, just paying for the privilege of having borrowed money. That's money going directly from your pocket into the financial system. And most people, they don't even think about it. It's just normal. Let me tell you about a man I knew. Smart guy, educated, working in finance. Ironically, he had 6 credit cards, all of them carrying balances, and every month He'd pay the minimums. Every month he'd tell himself he'd pay them off soon. Every month he'd find a reason to charge a little more. But I get rewards points, he'd say, as if getting 2% back on purchases while paying 22% interest was somehow a good deal, as if the credit card companies were giving away those rewards out of generosity rather than because the psychology works so perfectly that people spend more when using credit than they do with cash. He didn't see himself as trapped. He saw himself as managing, as doing what adults do, as participating in normal financial life. And that's exactly why the system works so well. It doesn't feel like a trap when everyone around you is in the same trap. It feels like life. But let me go deeper, because consumer debt is just the surface. The real brilliance of the system is in how it shapes your entire relationship with money from the moment you're old enough to understand the concept. You're taught to be a consumer, not a creator, not an investor, not an owner, a consumer. Your value in the economy is measured by your ability to consume. GDP growth depends on consumer spending. Jobs depend on consumer spending. The entire economic model depends on you spending money you don't have on things you don't need to impress people you don't like. And it starts early. So early you don't even recognize it. Children's television programming is interrupted by advertisements designed by psychologists to create desire. Teenagers are taught that their social status depends on what they wear, what they drive, what phone they carry. Young adults are bombarded with images of lives they can't afford, but are told they should aspire to. By the time you're old enough to make financial decisions, you've been programmed. Programmed to equate spending with happiness. Programmed to equate possessions with success. Programmed to equate debt with opportunity. And then the system gives you the tools to act on that programming: easy credit, low minimum payments, deferred interest, buy now, pay later, 0% financing. All of it designed to remove the friction between desire and acquisition. All of it designed to make it as easy as possible for you to spend money you haven't earned yet. Outstanding balances on bank cards increased to $100 trillion, up 7% from the previous year. $1 trillion in credit card debt. And that's increasing faster than almost any other category of debt. Now here's where it gets really interesting. The system doesn't just want you in debt. It wants you in the right amount of debt. Not so much that you default. That's wasteful. But enough that you're always working, always stressed, always one emergency away from crisis. Because that's when you're most compliant. That's when you don't risk changing jobs even though you hate your work. That's when you don't start that business you've been dreaming about. That's when you don't take the sabbatical to figure out what you really want. That's when you stay in line. I watched this play out with a woman I mentored. Brilliant mind, creative, talented, working in a job that was slowly destroying her soul. And she knew it. She'd talk about leaving, about pursuing her passion, about building something of her own. But she had a mortgage, car payments, credit card debt, student loans. And every time she got close to making a change, the fear would set in. I can't risk it. I have responsibilities. I have obligations, maybe later, when things are more stable. Later never came. Things never got more stable. The responsibilities grew. The obligations increased. And she stayed, year after year, her dreams deferred, her potential unrealized, her life spent servicing debts that never quite disappeared. That's not living. That's existing. That's being a productive unit in an economic system that doesn't care about your happiness, your fulfillment, your growth. It cares about your productivity, your consumption, your compliance. And the most insidious part, she blamed herself. She thought it was her failure, her lack of discipline, her inability to get ahead. She never questioned whether the game itself was rigged. Let me give you another angle on this. Only 46% of U.S. adults have enough emergency savings to cover 3 months of expenses. Think about that. More than half of Americans are 3 months away from financial catastrophe if they lose their income. 3 months. That's not a cushion. That's a precipice. And this isn't because Americans don't work hard. We work more hours than almost any developed nation. This isn't because we're not productive. Productivity has increased dramatically over the past 50 years. This is because the system is designed to extract value from your labor while returning just enough to keep you functioning. Look at what's happened to wages versus productivity. For decades, productivity grew. Companies made more profit, stock prices soared, and wages stagnated. The wealth that was created by increased productivity didn't go to the people doing the work. It went to the people who owned the work. And meanwhile, the cost of everything essential, housing, healthcare, education, has increased far faster than wages. So you're working harder, producing more, and falling further behind, not because you're doing something wrong, because the system is working exactly as designed. Let me tell you about another couple I knew. Different from the first. These were older, in their 50s. They'd been working for 30 years, saved diligently, or so they thought, put money into their 401k every month, paid down their mortgage, did everything the financial advisors told them to do. And then I looked at their actual numbers. Their 401k had grown, yes, but after fees, management fees, fund fees, advisory fees, transaction fees, they'd given back almost 30% of their returns over those 30 years. 30% gone, not to bad investments, to fees. To the financial industry that promised to help them build wealth while quietly extracting a substantial portion of that wealth for itself. Their mortgage, they'd refinanced 3 times over the years, each time lowering their payment by extending the term. 30 years ago, they started with a 30-year mortgage. Now, 30 years later, they still had 20 years left. They'd been paying for 3 decades, and they'd barely touched the principal. Almost everything had gone to interest. They thought they were building wealth. They were actually enriching banks and financial institutions, while building very little for themselves. And when I showed them the numbers, when I made it visible, I could see the realization wash over their faces. Not anger at first, sadness. A deep, profound sadness that they'd worked so hard for so long and had so little to show for it. Now let me talk about something that's going to make you uncomfortable. The education system, because this is where the programming really begins. This is where the system ensures its own perpetuation. Student loan debt has reached $161 trillion, affecting approximately 43 million borrowers, $1.61 trillion, and the average debt per borrower, substantial enough to shape the first 10 to 20 years of someone's adult financial life. But here's what's really happening. We tell children from the earliest age that education is the key to success, and it can be. But we've conflated education with credentials, with degrees, with institutional validation, and in doing so, we've created a system where young people go into massive debt for pieces of paper that may or may not translate into economic opportunity. Think about the absurdity of it. An 18-year-old with no credit history, no income, no assets. They can't get a credit card without a co-signer. They can't get a car loan. They can't rent an apartment. But they can borrow $50,000, $100,000, even $200,000 for education, with no proof it will generate a return. No business plan, no analysis, just faith. And the debt is guaranteed by the government, which means the schools have no incentive to keep costs down and the lenders have no risk. So what happens? Tuition increases far faster than inflation, far faster than wages, because there's an unlimited supply of borrowed money chasing a limited supply of prestigious degrees. Basic economics. And the students, they're sold a dream. Invest in yourself. Your earning potential will more than make up for the debt. You can't afford not to go to college, except that's not always true anymore, not even close. There are plenty of college graduates working jobs that don't require degrees, drowning in debt they can't discharge even through bankruptcy, questioning whether the investment was worth it. I knew a young man, brilliant kid, passionate about learning, but he made the mistake of following his passion into a degree that didn't have clear economic value, liberal arts, philosophy, beautiful subjects, important subjects, but not subjects that corporate America was lining up to pay premium salaries for. He graduated with $75,000 in debt, got a job that paid $35,000 a year, and suddenly his loan payments were eating up a quarter of his gross income. A quarter. Before taxes, before rent, before food, before anything else. He couldn't save, couldn't invest, could barely survive. And he was one of the lucky ones. He at least found a job. Some of his classmates were working retail, serving coffee, living with parents well into their 30s. Not because they were lazy or unmotivated, because the promise didn't match the reality. And here's the really cruel part. That debt, it's with them forever. Student loans are among the hardest forms of debt to discharge, even in bankruptcy. You can declare bankruptcy on credit card debt, on medical debt, on almost any other kind of debt. But student loans, those follow you to the grave. Why? Because if students could discharge that debt, the entire higher education financing model would collapse. The system depends on that debt being inescapable. It depends on young people being locked into repayment for decades. Because that's how the money flows. That's how the system sustains itself. But let's go even deeper, because education debt is just one component. Let me talk about housing, the so-called American dream. You're told that renting is throwing money away, that buying a house is building equity, that home ownership is the path to wealth. And there's truth in that. Historically, real estate has been one of the most reliable wealth-building tools for middle-class Americans. But let's look at what actually happens in practice. Mortgage debt stands at well up to 59 trillion, 12.59 trillion, the largest category of consumer debt by far, and the average mortgage is structured as a 30-year loan. Do you know what you actually pay when you take out a 30-year mortgage? Let's say you borrow $300,000 at 7% interest. Over 30 years, you'll pay approximately $718,000. $718,000 for a $300,000 loan. You're paying more in interest than you borrowed in principal. Now, is the house worth it? Maybe. If you stay there for 30 years. If the market appreciates. If you don't refinance multiple times. If you don't take out a home equity line of credit to pay for other things. But here's what usually happens. The average American moves every 7 to 10 years. And what do they do when they move? They sell the house, pay off the remaining mortgage balance, and buy another house with another mortgage. Starting the clock over, starting the interest payments over. So they're never actually building equity. They're just servicing debt, moving from one mortgage to another. And the banks collect interest on every transaction, every refinance, every new mortgage. The banks win no matter what. I watched a family do this 5 times over 25 years. They started with a modest home, affordable, manageable. But as they earned more, they upgraded. Bigger house, better neighborhood. And each time they told themselves they were building wealth. Look at how much our net worth has increased. Look at the equity in our home. Except it wasn't real equity. It was borrowed equity. Equity they could only access by going further into debt or by selling and buying something cheaper, which they never intended to do. So functionally, their wealth was theoretical, abstract. Numbers on paper that made them feel successful while they continued to work harder to afford the lifestyle their wealth implied they should have. And then 2008 happened. The market crashed. Their home value dropped below what they owed. Their paper wealth evaporated overnight, and suddenly they weren't wealthy homeowners. They were people trapped in underwater mortgages on houses they couldn't afford and couldn't sell. That's the thing about the American dream as it's currently sold. It's built on debt, on leverage, on the assumption that prices always go up, that income always increases, that nothing ever goes wrong. And when those assumptions prove false, people lose everything. But let me talk about something even more pervasive than education debt or mortgage debt. Let me talk about lifestyle inflation and the consumption treadmill. Here's how it works. You get your first job. Let's say you make $40,000 a year. That feels like a lot when you're just starting out. You get an apartment, buy some furniture, live modestly, maybe even save a little. Then you get a raise. Now you're making $50,000. Suddenly your apartment feels too small. Your car feels old. Your wardrobe feels inadequate, so you upgrade. Nicer apartment, newer car, better clothes. And your spending rises to match your income, or exceed it. Another promotion. Now you're making $70,000. Time to buy a house. Time to start thinking about starting a family. Time to furnish that house, landscape that yard, join that gym, subscribe to those services. And your spending rises again. By the time you're making 6 figures, you're living a 6-figure lifestyle, and you have nothing saved, nothing invested, no cushion, no freedom. Because every increase in income has been matched by an increase in spending. You're making more money than you ever dreamed of making when you started out, and you're just as broke, or more broke, because now the stakes are higher. The payments are bigger. The stress is greater. This is by design. The entire consumer economy depends on this treadmill. on you constantly wanting more, constantly upgrading, constantly chasing the next level. Because if you ever stop, if you ever say enough, the system loses a consumer, and the system can't afford that. I knew a man who broke free of this, not because he was particularly wise at first, but because he got sick. Serious illness that forced him to stop working for 2 years. And during those 2 years, something remarkable happened. He learned to live on almost nothing, cut every expense that wasn't essential, and discovered something profound. He didn't miss most of what he'd been spending money on, the expensive dinners he'd forgotten about the next day, the clothes he'd worn once, the subscriptions he never used, the stuff he'd accumulated to fill spaces in his home and his life. When he recovered and went back to work, he made a decision. He kept his expenses at the level they'd been during his illness. And everything else, everything he earned above that, he saved, he invested, he built actual wealth. Within 5 years, he had more financial security than people making twice his income. Within 10 years, he was financially independent, could have retired if he wanted to. And his friends thought he was either lying about his income or living some kind of miserable, deprived existence. They couldn't understand that he'd simply opted out, stepped off the treadmill, stopped playing the game, and in doing so he'd won, not by accumulating more, by needing less. That's the secret they don't want you to know. Your power isn't in your earning, it's in your spending, or more precisely in your not spending. Because every dollar you don't spend is a dollar they don't capture. Every dollar you save is a dollar that works for you instead of for the system. But they've made it so hard, so socially difficult, so psychologically challenging, to live below your means in a culture that celebrates excess, to drive an older car when everyone else is upgrading, to live in a modest home when you could afford more, to say no to experiences and purchases that everyone else treats as normal and necessary. The social pressure is real. The judgment is real. The feeling of being left out, left behind, less than, that's real. And most people can't withstand it. Most people cave. Most people stay on the treadmill because getting off feels like failure. Let me tell you about another mechanism of control: complexity. The deliberate, intentional complexity of the financial system. Because if people understood how it really worked, they might opt out. Think about your retirement account, your 401k or IRA. You put money in. You choose from a menu of investment options you don't really understand. You hope it grows. You check it occasionally. And you trust that when you retire, there will be enough. But do you understand the fees? Really understand them? Most people don't. They see 21% annual management fee and think that's reasonable. That's not too much. But they don't understand compound effects over time. If you invest $1 and it grows at 8% annually for 40 years, it becomes $21.72. But if you pay just 1% in fees annually, that same dollar only grows to $14.56. You've given up a third of your potential wealth. A third to fees, and that's assuming only 1%. Most retirement accounts have multiple layers of fees: fund management fees, advisory fees, administrative fees, transaction fees, fees on fees. By the time you actually retire, the financial industry may have captured 40, even 50% of what your money would have grown to if those fees didn't exist. But they don't tell you that. They show you gross returns. They emphasize how much your account has grown. They never show you how much more it would have grown without their involvement. Because if they did, you might ask uncomfortable questions, like why you need them at all, like whether you could just buy index funds with minimal fees and do better, like whether this entire industry exists more for its own benefit than for yours. The same complexity exists everywhere in personal finance. Mortgage terms you need a lawyer to understand. Credit card agreements written in deliberately obscure language. Insurance policies that seem to cover everything until you need them and discover all the exclusions. Tax codes so complex that even experts disagree on interpretation. All of this complexity serves a purpose. It keeps you dependent. It keeps you confused. It keeps you from recognizing how much is being extracted from your labor, your savings, your wealth. And if you try to learn, if you try to educate yourself, you're met with an avalanche of conflicting information. Financial gurus selling different strategies. News outlets breathlessly reporting on market movements. Social media influencers promising shortcuts to wealth. Everyone has an angle. Everyone's selling something. And the genuine information, the clear, straightforward, actionable wisdom that's buried under mountains of noise. So most people give up. They outsource their financial decisions to experts who may or may not have their best interests at heart. They follow conventional wisdom that may be decades out of date. They do what everyone else is doing and hope it works out. And for most people, it doesn't work out. Not the way they hoped. They reach retirement with less than they need. They work longer than they wanted. They scale back their dreams. They accept less. And they think it's their fault.